Hey everyone, good morning or good afternoon, wherever you are. My name is Brent Moore. It's time for Long Options. We do this weekly and glad to be here. We look at long puts, we look at long calls in this class. Lately, probably more puts just because of the way the market's been, but we've had a little bit of a recovery in the market. We'll look at that. And I'm joined alongside in the chat by Connie Hill, who's helping me out. She's a longtime coach here and very knowledgeable on everything I'm going through here today. So as you have questions between Connie and myself, we'll do our best to get those questions answered. You can follow either of us on X, formerly known as Twitter, at Brent Moore CS, at Connie Hill CS. And what are we going to do today? Well, I want to add some trades to our paper money portfolio here. And in the process, I want to demonstrate estimating potential profits or losses on the trade. So that's the goal here. So we're going to go for that. Before we do so, let me just remind you that options do carry a high level of risk and are not suitable for all investors. And the information today is for general informational purposes only, and it's not a recommendation of any security, chart pattern, or strategy. Paper money application, which we'll be using, is provided for educational purposes only. All investing involves risk, including loss of principal. I see some familiar names in the chat. We're glad you're here. And those of you who are first timers that I don't recognize your name, great. We're glad you're here too. Thanks for watching. And if you're watching on a recording, wonderful. Past performance of any security or strategy does not guarantee future results or success. And there we go. Oh, I'm probably not going to factor in commissions and fees in any of our examples, but just realize they are a consideration. Let's take a look at the markets right now. About break even on the S&P 500 right now. You can see the trend we've been in. No surprise, potential resistance right above us. That's where we hit some lows, low, kind of gap down from there. We've been kind of flirting with that area, but we haven't broken above it. That coincides with the 20-day moving average, which you'll see I have on my chart, as well as a trend line I drew. So that's kind of an area, and we've seen, we've come up to this area and we've also seen a diminution of the volatility as well. I mean, just look at the size of the candles that we had here and just the last couple of days. Now, I'm not saying we're done with volatile times in the market or anything, but I'm just saying the markets have seemingly slowed down a little bit at this point. So what I want to do though is I want to look at some options trades. So I want to look at example trades. I want to estimate potential profits or losses on those trades and then repeat the process, okay? So we're going to do that. And what I'm going to do is I'm going to start off with Oracle. One thing to just be aware of though is we've just started earnings season. So a lot of companies have earnings. You don't have to avoid earnings when you're trading, but a lot of traders do like to avoid earnings. Earnings are a time of heightened uncertainty. And so in your trades that you look at, be aware probably of what earnings are, when earnings dates are. One way to do so is to go to the Analyze tab. There's an Earnings tab here on this. And so for Oracle, we have June 9th as earnings. So we got a little ways on earnings to go on Oracle, but it is something to be aware of there. And another thing to maybe be aware of with long options is implied volatility. These are positive vega trades, okay? Long call, long put, both positive vega trades. It means if implied volatilities go up, it's going to tend to benefit you in the trade. If implied volatilities go down, it's going to tend to hurt your trade. Well, they've gone down a little bit, and that's just market volatilities have gone down. If the stock goes down, there's an increased chance that implied volatilities will go up if the stock goes down. That's what we're hoping for if we're doing a put trade here. And that's what I'm looking at, a long put example. A bearish example because our trend is down. We've had lower highs, lower lows. No, I don't see a huge sign of this reversing itself right now. You may disagree. If you're bullish, you certainly would not do a long put trade. In this example trade, though, we're going to take a bearish stance on this. If anything, that should help to reverse the decline in implied volatilities, but you never know. Also, when you're thinking about implied volatilities, with earnings, when you have a company, in fact, let me just zoom out to, let me go to a little longer term chart here so we can see implied volatility. What typically happens on earnings, some stocks more than other stocks, but it's not guaranteed, is you kind of get an increase in implied volatility before earnings and then drops off after earnings. Your increase in implied volatility before and it drops off after earnings. You see the pattern there, okay? So we've got earnings, I don't know, out here somewhere. It probably isn't unreasonable to expect implied volatilities to increase. So that's just some context on this trade here right now. But I'm going to look at a put trade on Oracle, and I'm going to look for to try and estimate what kind of profit or loss or what kind of option prices we're looking at potentially on this trade here if the stock does kind of what we hope it does, and if it goes against us, what are we going to do? So what I'm going to say is this, is I'm going to put my target down here kind of where our low was. You can see our low price right on down there. So I'm going to say my target is around 120 here. Okay. That would be in continuance of the trend that we've had going down. That's my target price in this example. Where am I going to stop out? Well, I'm going to say, look, if we break above our recent highs, I'm going to give it a little wiggle room here. In fact, maybe I'll go to this high, which was our high candle there, which is right at 140, and I'll go about 1% or so above that. So I'm going to say 142 stop, exit. I'm going to write stop, even though technically it's not a stop price. We're going to say 142, I'm just going to jot that down so I don't forget, and 120. So 120 is the target on the underlying stock. 142 is the bad scenario we're going to look to get out. But and from a stock perspective, you can kind of say, well, look, the stock's at 135. The difference between 135 and 142 is about $7. We're going to call that risk. Okay. And I'll have another comment on that in just one sec. And the difference between 135 and our 120 target is about $15. We're going to call that reward. So that's basically on the stock itself about a 2-to-1 reward to risk ratio. Okay. Now, I say risk. Technically, we risk more than, you know, we don't know exactly if we place a stop, or we don't know exactly we're going to get out. Even if we put an order-based, a rules-based order to get out at 142, doesn't mean we're getting out at 142. The stock can gap up and go to 150, 160 or more. And then we'll probably get out closer to that price. But this is just kind of an initial calculation of reward to risk ratio, something that you may consider doing when you're doing your long calls or your long puts. In this case, it's a long put. But let's head on over here. Also, expiration date. I didn't mention expiration date. How long am I expecting this to go? Well, look, for it to go from low to high, from it to go from our target price up to where we're at right now, it took 1, 2, 3, 4, maybe 9 days or something like that. That's trading days. Couple weeks. We're going to give it a little more wiggle room, a little more leeway than that. So we'll go at least 3 or 4 weeks on this trade. So let's do this. Let's go to trade. We've got Oracle. I'm going to go 3 or 4 weeks out. I'll go to May 16th. That's before our earnings date anyway, but we're not planning, we may not, very well may not hold it for that length of time. But I'm going to look at the puts, and what I'm going to do is I'm going to add in some columns here. You see we got bid, ask, volume, open interest. What I'm going to do is this. And by the way, as I look at these, you can see, oh, we've got open interest is pretty high on this. You can look at your bid-ask spreads. They're relatively tight on this. So I'll go a little bit in the money maybe. Stock's at 134, about 135. Let's go to the 130 strike. So I'm just going to concentrate on that 130 strike. I'll get fewer strikes just to make it a little easier to see. There's our 130 strike. I'm going to change this to Theo price mark, theoretical price. Now, if you've used this before, those numbers may be different here. So you can click on here and you can reset it. Just always reset, clear it out, give it a fresh start, because you'll put some numbers in here. And then what you'll do is you'll come back later and you'll forget about it and it'll show some off numbers here. But our assumption is we're going to be in this trade about 2 weeks. So I'm going to go here. I'm going to go forward a couple weeks. Today's the 15th. We'll go to the 29th here. I change that. Why does that? It's already substantially gone down there. See how much value that time component is hurting our option there on that? But so from 392 down to 250. But what is this option price going to be? Let me go and I'm going to do this and I'm going to say, what if the stock price does what we want it to and goes down to about $120? Well, right now we're about 134. So I'm going to say about a $15 drop in price. I'm going to put a minus sign in front of that, type in 15, and that goes a little bit beyond where I wanted to go. So I'll go right to 120 just with this little adjustment tool. Okay. So now our resulting stock price is 120. Now when we look at this, let's see what happens. Our initial mark, which is $4 to start, and that mark is basically going to be probably kind of mid-price between bid price and ask price. So $4 to start goes to theoretical of 1094. Okay. $400 for a contract, because our multiplier is 100, goes up to 1094, and the number's changing a little bit here. So $400 goes to $1,000, almost $1,100. That's not terrible. That's not terrible. And I'm just jotting that down. What if it goes against us though? We said, well, if it goes against us, we're going to look to get out at 142. Well, let me do this same adjustment. I'll keep the same expiration date on this. And I'm going to make this 142. So that's going to be a positive number. And that's going to be about a $7 gain. Again, we'll call that good on the money. And our mark, which started at, well, again, $4 is where it was before it moved. Now about 95 cents here, okay? 0.95 mark. Now, some of you are thinking, he did not change the implied volatility. This is not volume. This VOL is not volume. This is implied volatility. You can adjust that volatility if you want. That's a little bit more uncertain as to what the implied volatility is going to do, but you can look here and you can kind of look here, implied volatility, and kind of estimate what the implied volatility is going to do, depending on what you think, how it's going to react before earnings, how you think it's going to react if the stock goes up or down. You can tweak that. For our purposes today, I'm not going to tweak that right now. And I just want to do this. I want to just mention kind of what are we looking at in terms of profits or losses on this trade. We said we were starting with a $4 initial cost there. If it goes our way, in other words, down, because it's a put, this is why I jotted those numbers down, we said it may go up to 1094. And if it goes against us, assuming we got out at the stop price, our exit price, which is certainly no guarantee. It may go down to 0.95 approximately. So what does that equate to in terms of dollar value? That's 1094 minus 4 is $694 gain. Okay, we're going to call that reward, theoretical reward. Of course, these are theoretical, and the theo price is not a guarantee of what exactly price this is going to be. It's an estimation. It's an estimation, but it can be a helpful tool. What's our risk? Our risk was going to be the difference between the $4 initial price. 95-cent resulting price is $3.05 risk on that trade. Okay. Now, of course, long calls, long puts are not what you'd call high probability trades. Because you have that time decay in there, if the stock kind of just goes sideways, well, we're going to be losing money most likely on that trade. Okay. There are some, implied volatilities can change out a little bit, but we're probably losing money if the stock doesn't move. We need it to move here. If it does move, that's what we got. That's our reward to risk ratio that we have. So you can estimate potential profits or losses. This would be for one contract. Do 3 contracts, multiply those numbers by 3. Remember, those are estimates, but that's how you can do that. Now, if we want to actually place the trade, what I'm going to do is I'm going to go to 130. I'm going to go to my put. I'm going to right click on here. I'm going to buy custom with a stop. I'm going to pull this up. This is my initial trade. Now, we're actually going to change that stop to a market. We're going to make that good till canceled. We're going to go to our gear over here on the right. It's going to bring up a window. There we go. Let me just kind of shrink that down just a little bit here. Actually, maybe not. Conditions. There we go. I'm going to scroll down here. Right under where it says symbol. I'm going to highlight it. I'm going to click on it. It automatically fills in that. We're going to mark greater than or equal to if the stock goes, what do we say, up to 142. That it's going to get us out. That was the bad scenario, right? That's if the trade goes against us. If the trade goes our way, we're going to say less than or equal to 120. $120. Click my enter key, click save. There's my trade. Let me just click right here and see if we're going to fill. That's showing at the natural price. Mid is only 5 cents off that. I don't know. We'll just go in natural price. Let me click on confirm and send. I want to get in that trade. I'm going to add that to our long single options area and get out and put that in there. When I click back on this chart, just kind of look at this. This is the trend we have. Our goal is for it to get out here. It'll automatically get out if we get it here. It'll automatically get out if we go up here. We're expecting a bounce. The stock flagged here and went down. It flagged here and went down, down. That's the expectation. The expectation may not come to fruition, but that's the goal here on that. Other points, other management. You don't really have to do that much more management on this trade because we have our exits in place. Now, let's say this starts to go down here. Could we then decide, well, maybe I'll tweak this a little bit and move my exit down a little bit, move it from there to there? You can do that. You can do that if you want, but there we go. That's the way that works. Any questions on that trade? In terms of management of these, also, we're going to look to get out once we get, close to expiration. If we haven't hit our target, if we haven't hit our exit, and we get within a week of expiration, we're probably just going to get out of that trade at that point. All right. There we go. Let's look at another example. Let's do another one. We did a bearish example, long put trade. Let's do a bullish example. Let's do AVGO. Now, if you look at the markets, you're going to go, look, the markets are bearish. As you scroll through the stocks, go to the S&P 500, S&P 100, whatever, and look at stocks. Most of them are fairly bearish. And then if you're trying to avoid earnings, which I'm kind of trying to do, so I've excluded stocks that have earnings coming up here in the near future. Earnings on AVGO are, sorry, I clicked on the wrong thing, are June 11th. Okay, so we got a little while on here. Now you may be going, this is kind of a downtrend here. And I would agree, actually, it has been a downtrend. My speculation here is that we may be breaking above our highs here and it's going up. But we're not there yet. This is our resistance. I'm going to call this a horizontal resistance. And, well, we're below that right now. So for this trade, what I'm going to do is I'm going to say I only want to get in if the stock breaks above my resistance line. Okay? Only if it breaks above my resistance line. Well, so look, here's this level right here, 184, and I'm not going to say like 184 and a penny or anything. I'm going to give it a full percent or so above that. So I'm going to say we're going to enter at 186, and I'm just going to jot this down here. 186 is going to be our entry. Okay. Where's our target price on this? Well, look, I could do a target up here. That's that price right there. That's where that high was. That's where that low was. That's where we bounced. That's a potential target. That's maybe a more aggressive target. I could also do a target up to these highs right here. Let me just draw that in there, which coincides more or less to those lows. I'll go to that. I'm going to go to that high right there. I'm going to say right around there. Okay, right around $200. So here's a shorter term target, a closer, less aggressive target. Here's a more aggressive target, and you can choose. And that's always, this is going to be it's going to have a higher probability of reaching this one than reaching this one because it's closer. It's easier to attain. If you want to be more aggressive, maybe you think the market is turning around and the market's going to be more bullish, maybe you go with the more aggressive target. In this case, I'm going to go with the nearer term target here. Okay, I'm going to go around 200 on my target. But let me just make sure I've jotted those down. We're going to say target price was 200. Our stop, I'm going to say, look, we're only getting in if we break above this resistance. This is a breakout trade. Old resistance becomes new support. Now, it's not new support yet because we haven't broken above it yet, but we're only getting in if we break above it. At that point, I'm going to call it new support. And again, we're getting in around 186. Our resistance level is about 184. I'm going to call that, and that will be a new support at that point in our estimation here of this class. And I'm going to go about 1% below that. So I'm going to go to about a 182 stop. Do you see how I came up with that 182 stop? I'm saying my support level is about 184. I'm going about 1% below that, okay, which is technically $1.84 below, but I'm not going to quibble over exact pricing here on that. I'm going to call my stop, 182, okay? So I've got my numbers. Let's head on over and estimate. Now, this one's a little bit more tricky because on my trade tab, I'm going to go, let's go a little bit shorter term. I'm going to go out 24 days on this one. okay? We have the near-term target. It's not going to take as long. Just rule of thumb here on these is I'm going to estimate the time it's going to take to get there, and I'm expecting maybe a week to get there. Who knows? If things go well, of course, it could go against us. And then I'm going to add on a week or two to the trade in terms of expiration date. Okay, so I have May 9th on this. I'm doing a call on this side. So I'm looking at calls over here. Remember, I got to reset. This was still looking at those numbers from my other trade. So let me reset that. And we said we think it's going to take about a week. So I'm just going to go out a week's worth of time here on this. Now, initially on the other trade, we just said, and I'll go in the money just a little bit. We were just taking that initial that initial mark price as the price we're getting in at. But in this case, that's not the case. We're getting in at a higher price than where it's at right now. We're only getting in if the stock goes up to 186. So I need to adjust our entry price on this. So I'm going to go up to 186, which is about roughly a $7 move up. So I'm going to put in $7. I'll tweak that a little bit and get it right to 186. Oop, I overshot. What am I doing? Okay, close enough. Okay. And again, I'm not going to tweak that implied volatility, but you can. Okay. If anything, implied volatilities would probably go down if the stock goes up. So this is opposite puts. That's one advantage, by the way, with long options of long puts versus long calls. If long puts go your direction, it's more likely you're going to have positive implied volatility effects on that option price. If a long call goes your direction, i.e. up, the stock goes up, it's more likely you're going to have negative implied volatility effects on your option price. Now, I guess you can think about it the other way as well and say, hey, if the long call goes against me, then it actually helps, the implied volatility helps me out there in that case. But in this case, if it's going forward, we adjusted our initial entry price on the 170 strike to 15, I'm going to say 1540. Okay, that's our initial price on that. I know it's moving around. Okay. Then when are we getting out? Well, we're looking to get out on the high side if it goes up to 200. Well, how am I going to get to 200? Well, 200 is about $21 or so from where we're at right now. So let me go up to 21. Close enough. That's almost right on the nose there. Okay, we're going to call that good. Let's see, we're going 175 strike. Deal price, 26.65. 26, let me just mark this down. 26.65. And what if it goes against us? Well, if it goes against us, we were saying that's going to be at the 182 price, which is up about $3 from where we're at right now. So I'm going to do $3, 182, close enough. And when I say close enough, it's off a few pennies. Number one, it's moving. It's a moving target. Number two, it's an estimation. It's not going to be likely exactly on the nose anyway. For the 175, that's a $12.46 stop. Okay, so let's just look at our numbers here. Entry price is going to be for the option 1540. Remember, the multiplier is 100 on this, so it's going to cost us about $1,540, not including commissions here, for this contract. It's a bullish trade. If it goes against us and we get out exactly where in this, exactly at that price, 1246 is our exit. If things go south on us, this is our entry. And our exit, if things go our direction, is 2665. That's $2,665. That is an estimation. So what's our profit loss? Well, I'm going to get my calculator here out on this one. I'm going to take 15.40, subtract 12.46. That's roughly, it's 294. I'm going to say roughly $300 loss. Okay. And in terms of, I'll put parentheses around that because that's a loss. And in terms of gain, 26.65 minus 15.40 is about $1,125 or $1,125 potential gain. Now, there's a lot of contingencies in this. Number one, we may never even get to that entry order, right? The stock may not go up and hit that. If it goes up and hits that, we need it to move, up a little ways to get to that level. And of course, these aren't exact numbers. We don't know exactly what they're going to be. And if it stops, if we were to get stopped out at that price, we don't know we're going to get stopped out exactly there. So that's that. So that gives us a nice positive reward to risk ratio on this trade. Good. That's fine. And well, let's do the trade. Okay. Let's see what we got here. So we'll do that trade, and let me just double check chats. I know Connie's helping us out in the chat here. How long does it take after this course? So 2683. Oh, so I assume you're talking about this number right here, Chuck. Chuck in the chats, those of you not watching the chat, says his is showing 2683. Look, as we're looking at these numbers are bouncing around, okay? So I wouldn't take too much into that. And I wouldn't think too much about, I also, number one, the numbers are bouncing around, but don't attribute too much precision to these numbers in terms of how close that's going to be to what the real life scenarios. Our goal is to come up with estimates here on that. So we have a general idea on those. Let's put in that trade though, okay? Let's see, how long does it take after this course for it to typically show up in the Trader Talks archive so we review it? Is it immediate? Okay, good question. So once this class is completed, this webcast is completed, how long does it take to show up on the Trader Talks Schwab channel on YouTube? This is applicable to everybody. Let me just take this as a quick time to plug, subscribe to the Trader Talks YouTube channel. I know Connie has answered this in the chat here, but I think it's an important question for everybody. Those of you watching on recording as well. What happens is we have to have a compliance review on it. Okay, they got to make sure I stay in line and don't mess up on anything. And once we get the thumbs up on that, then it gets posted. Typically, I don't know, a couple hours maybe, something like that, it'll be up. Let's do this trade though. Let's enter this trade here. So we said we were doing a 175. Let me just point this out. I went in the money a little bit on this. So, a couple months back, 3 months back or so, I did kind of a sample trading plan, an example trading plan for this class. And the class for both swing trades, which is what you do, which is what we just did, and trend trades, which are longer term trades. And so if you want those rules sample rules that we're using in this class, then you can review those. You can just go to the playlist for this class. But I'm going just a little bit in the money on this. Again, I already talked about expiration dates on that. And just make sure you're double checking liquidity, regardless of the type of trade. It doesn't matter whether you're doing long options, short options, anything. double check your liquidity. You can check open interest. You can check that bid ask spread. Okay, so, but here's what I'm going to do. I'm going to right click on this. I'm going to do buy custom, similar to before, with a stop. Here's my entry. Here's my exit. I'm going to make that stop a market. So technically it's not a stop. It's just a rules-based order, a contingent order, but based on entry, based on it meeting certain conditions. We're going to click on that gear. I'm going to look here and we're going to say, I got to remember to adjust my entry too, by the way. We're going to get out if AVGO, I jotted it down, but I got to read my writing here, marks less than or equal to 182. I'm going to get out if AVGO marks greater than or equal to, watch your little signs there, and we said 200 on that. Now, if I just entered this order as is, it would fill right away because right now we're already less than or equal to 182. But remember, we're only getting in if we break out. So I'm going to click on that gear. This is my entry order now. We're only getting if AVGO marks greater than or equal to 186. Now, let me save that. Let's talk about one other condition. Maybe I'm looking at this and I'm kind of waiting on this and I go, well, look, I'm looking for the breakout here, but if this just kind of peters along for a little while and eventually breaks it later, I don't want to do this trade anymore or anything like that. You can do that. Let me go back to my trade. Let me go back to my entry rule and we can say, here's my main entry rule, but I also want to cancel this if it doesn't fill within, I don't know, by the end of the week, say. So I'm going to, well, Friday's a holiday. So I'm going to go Thursday at the same time. At this time, this is showing in your local time zone, by the way, unless you have some different setting on there. And so this will cancel this order if it doesn't fill at that point. So I'm going to save that and we're going to confirm and send. I'm going to go here. I'm going to click on long, put that in our long single options bucket. Now our target isn't as far away if assuming we have the breakout. And we'll see. We'll let it go. Management, same deal. Let's say we break out. Remember, this is our target right here. Let's say we break out. And we're up and we're getting close. We could possibly move your stop up along the way. But when you have both a target price and a stop price, it makes management a little more hands-off probably in that regard of you don't have to worry about constantly, adjusting your stop necessarily. You may want to adjust that stop if you want, but we're not going to move that stop down. We may move it up a little bit there, okay? Now, what's the impact on the margin? The most you can lose on this trade, this is from Vic, good question. The most you can lose on this trade is the initial cost of the trade, okay? So if we pay 180, what do we say? 186 for this, okay? The most we could lose, and it's a fair, it's an expensive stock. That's actually not the option price. What's our option price? Our option price was 15, estimated option entry price was 1540, okay? So that means the cost is, if assuming we got filled at 1540 plus commissions, that's the most we can lose. That's your impact right there, okay? What you can lose on that. Okay, let me just talk about other management. Remember, when we're thinking about management, think about what you're going to do when you're going to get out if the stock goes your way. Okay, we have that. We have that exit there. Where are we going to get out if it goes against us? We have our stop. What are we going to do if the stock does nothing and it just kind of goes sideways? Maybe we enter the trade and it just kind of goes sideways. Then we'll get out probably with the week to go, maybe even more. If it's just going sideways, if we're not bullish on that trade anymore, we may just get out earlier. 10 days to go to expiration, a week to go to expiration. Looking to get out on that for our management rules for this class. Doesn't mean you can't have different rules here. Different people do have different rules, but that's how that works. Okay, let me just address questions and then we'll wrap it up, I think, because we're just about at time. And Connie has been doing a good job doing questions, so thank you, Connie. I think we're all caught up on that. So I do appreciate you guys joining me. Remember to check out, something Connie mentioned in the chat was we do have ETF sessions. One in particular, let me just mention here, because Connie teaches the ETF class on Mondays. Mondays, 4 o'clock Eastern time, trading ETFs. That class is not recorded. It's not archived. So you need to watch it live, 4 o'clock Eastern time Mondays. It's a great class. I do the chat for that class quite often. Connie does a great job. So make sure you check that out. Coming up next, we have getting started with technical analysis. So I do things like trends and support and resistance lines in this class. You want to learn about that and more? Getting started with technical analysis. That's coming up at the top of the hour. Thank you all for joining me. Appreciate you. And I may be out for this class next week, but I'll definitely be back in 2 weeks. And you guys have a wonderful rest of the day. Bye-bye, everybody.